So today we are going to go over exercise 3-5. The company name is Huang Limited, and the balance in the year end December 31st, 2017 is as follows. The company has no account receivable on hand. There is no accumulated depreciation equipment. There is an equipment worth $210,000. There is a interest payable $0. There is note payable $240,000, and the company has an asset which is prepaid insurance worth $63,100, and the company doesn't have any salaries and wages payable. It has $73,500 of supplies and $900,000 of unearned service revenue. So the question asks us to prepare an annual adjusting entries for the 7 items described above. So what are the 7 items? Let's go one by one. Okay, the first one. First one is Huang borrowed $240,000 by signing 6% one-year note on October 1st, 2017. Okay, 6% is an annual interest. If there is no mention, just assume it as an annual interest. Okay, so 6% annual interest. So we have to calculate how many months has passed since the company has borrowed money on October 1st. So October 1st, and then November 1st, and then December 1st, and then December 31st. So there are 1, 2, 3 months has passed since the company has borrowed money. So 3 months amount of interest will have occurred, and we have to calculate the interest expense, which is $240,000 times 6%. And as I said earlier, this is an annual interest rate, and you have to calculate by multiplying 3 and dividing it by 12. Why dividing it by 12? Because a year has 12 months. So that will give us 3,600, and you debit interest expense, and it doesn't mention whether it has paid in cash or not. We just assume it will pay later. So interest payable 3,600. Okay, let's move on to the second one. Okay, by calculating how much supplies are on hand, it says 23,400 of supplies are on hand. Okay, so if you calculate, the calculation equation is like this. There were 73,500 amount of supplies minus the used amount will be supplies on hand. So how much are used? 50,100 of supplies are used. So we have to record supplies expense as 50,100 on the debit side, and on the credit side we have to deduct supplies by the same amount. Okay, simple, right? Number 3, we are going to depreciate the equipment. So the equipment, if you see earlier, had no accumulated depreciation equipment, but now we have to calculate the depreciation amount. So it says 3 months. Oh, not 3 months. It says $30,000 of depreciation expense has occurred. So we just simply write depreciation expense on the debit side, and we accumulated on account called accumulated depreciation equipment, 30,000. why do we just not depreciate it and credit equipment? Why? Because if we do this, then in the the all the depreciation is over, then we don't know how much the equipment costs. So we have this accumulated depreciation equipment account. Okay, very simple. And on number 4, it says Huang paid $63,000 for 12 months of insurance coverage on June 1st, 2017. So a lot of you have missed this one. There was, I think, a counting problem. So if you just use your hand, or uh, you just draw it like this. So from June 1st to December 31st, how many months are there? So if you just count 1, 2, 3, 4, 5, 6, and we have 7. There are total 7 months. Okay, so on June 1st, the company has recorded already that they have prepaid insurance as their asset, so they would debit prepaid insurance $63,000 and cash $63,000, or cash, or something else. It doesn't have to be cash. So $63,000 will cover 12 months, and we already have used how many months? 7 months. So we have to calculate the insurance expense and record it in our journal as an expense. So $63,000 for 12 months coverage, and we have already used 7 months amount out of 12 months, so that will give us $36,750. So insurance expense $36,750 on the debit side, and we have to cancel some of our asset by crediting prepaid insurance by the same amount. And by doing this, prepaid insurance in our hand will be reduced. Okay? And number 5, it says on December 1st, 2017, Huang collected net $900,000 for consulting service to be performed from December 1st through March 31st. Another counting issue. So it has already received some money, which was $900,000 for their service from December 1st to March 31st. So we have to calculate how many months are there. So there are 1, there are 2, there are 3, there are 4 months from December 1st to October 31st. So there are total 4 months, and 1 month has passed, right? So from December 1st to December 31st. So we have to recognize service revenue by 1/4 of what is already paid. So out of the $900,000, 1/4 is $225,000, and we have to recognize it as our service revenue because we have performed our service for 1 month. So service revenue for $225,000, right? And we have to debit unearned service revenue by the same amount. So this effect will cancel out the unearned service revenue that was recorded when when the cash was given here. For example, December 1st, the company has recorded cash 900,000 and unearned service revenue for $900,000. So December 31st, journal will cancel out the service unearned service revenue, which is an obligation, uh, by $225,000. So our obligation has reduced after 1 month of service. Okay, let's go to number 6. Huang performed consulting service for a client in December 2017. The client will be billed net $117,000. So it's very simple. So it has already performed service. So we have to recognize the service revenue. By how much? $117,000. And it says it will be billed, the customer will be billed. That means they have not paid yet in cash. So the company has some account receivable by the same amount, $117,000. And that's very simple. And let's move on to number 7. So it says Huang pays his employees total salaries of $270,000 every Monday for the preceding 5-day week. On Monday, December 29, employees were paid for the week ending December 26. All employees worked the last 3 days of 2017. So basically, it's saying that they are paid week. So they are weekly paid workers. So the last payment was on December 26. Okay. And they worked 3 days, 3 working days. It may not have to be working days, but they worked 3 days out of 5 days. So out of $170,000, if we multiply 3 over 5, that will give us $162,000. And we have to take it journal as a salaries and wages expense by $162,000, and salaries and wages payable by $162,000, the same amount, because the company has not paid yet, but it has to record that this amount because the work is already performed by the employees in year 2017. So after 2 more days of working, they will be paid, right? So, and then we can do we can cancel salaries and wages payable, and for example, cash $270,000, salaries, wages expense by how much? 2/5, and salaries and wages payable by $162,000. This transaction, this journal will be in 2018. Okay. So at the year end, what you have to do is just this journal. Okay. This one. All right. This is it for today, and I will go over the next exercise, which is exercise 3-8 in another video, and we will go over problem 3-5 in our TA session. Okay, so if you have any question on problem 3-5, please come to TA session. And that's it for today. Thank you.